Oh, this is Nick.
Hi, Nick. We are. Tammy, you there?
Yes, I am.
And Nick is here.
I am here.
All right.
How's it going, everyone?
Morning, Nick.
Morning, Nick.
How are we doing today?
Good, thank you.
Beautiful day here in Washington County.
You know, the sun is shining. It would have been, I wish I could be there in person.
That would be nice.
Man, this is crazy times we're in, isn't it?
Yep.
But what can we do? We just gotta, we'll get through it.
What do you got, bro?
Everyone's staying safe and healthy, I'm assuming.
Well, that's why you're on live stream here.
Yes. Well, it is 9:30. We'll go ahead and convene the investment committee meeting.
Okay, boys. You got your papers in front of you. I hope you had time to go over them.
Yes, ma'am.
We've only had, of course, 2 deposits for the January interest and February interest. We don't have March until, of course, the end. But right now, what we've collected from Meter is $95,198.45. And the interest from People's Bank is $49,522.72, which gives us an interest balance to date of $144,721.17. If you also look on your paper, underneath the People's Bank interest, the history of what we have with Meter, that we did while these maturing. Nick just found that it was best, correct, Nick, to put it back into People's Bank.
Right. And given with where interest rates moved, they give you some of the Fed cut, and we can get to that here, but just to give everyone a high level, quick overview, and in your packet, then you're looking on that front page that's talking through the economic changes, if you will, in March, which these statistics, everything that you're being shown within this packet are of earlier in the month, which are new numbers haven't populated in our presentations yet. But the Fed, as you guys are aware, I'm sure, and I've seen in the news, cut interest rates back down to 0. Right. So we're in that 0 to 0.25 range, which has ultimately, and again, you look at geopolitical risk and macroeconomics, there's a lot of pressure on yields here domestically. And when rates drop on the front end, that everything else tends to follow suit, right? And so just to give you an idea, last year we were having these conversations, the Fed funds rate has drastically changed. And so as we are assessing, and this is kudos to Tammy and us for working together here, going back to People's prior to rates compressing, we were able to go back to People's and lock in again that 2.25 rate for the next 3 years. And right now, given where interest rates are, for us to stay competitive and ultimately be your fiduciary to what makes sense, we're continuing to monitor the marketplace to see which we would call them buckets, right? You have your Meter US Bank bucket, and then you have your People's Local Bank bucket. And so the decision was made at that point in time to move to maturities, as Tammy said, back to People's to earn that higher rate of interest until things would change from People's end. Now, we did find out that there's a cap to the amount that we can keep at People's. So this will ultimately continue to play into our structure, and this will continue to change how we're working with the local bank.
Nick, what's that cap?
25 million.
The cap,
Okay.
yeah, 25 million, yes, sir.
Okay. And are there restrictions in terms of moving money back and forth? How often can we do that?
The first one being is from the Meter side, we want to wait until securities are maturing or called before we would move that to People's. At first $25 million at the bank. And so at points in time, that's you guys carry very large balances there at fluctuating points during the year. So we have to weigh and pick and choose. We want to butt up right to that 25 million, and then everything that we'd be carrying over, we would call it, would then get moved or B, continue to stay at U.S. Bank and invested in the market.
Okay, thank you. Makes sense.
Yeah,
That's pretty thorough.
And we would expect, and as you guys could imagine, we timed up working with Peoples and locking in that rate at the most opportune time. Now, given with where rates are, I mean, you're earning 2% higher short term than you are anywhere else in the marketplace. So we're hoping, again, knock on wood, that we're not going to get a call from Peoples looking to renegotiate that rate, even though because we are locked into that contract. But Kay and I, we've been talking and having that correspondence that in the event that something would pop up, we can adjust. That's the thing. We're staying in contact, business as usual for us at our company. Everybody's our Bloombergs are up and running, business as usual. So Tammy and I will continue to work together to ensure that we're appropriating funds in each appropriate bucket, if you will.
Sounds great, Nick. Thank you.
No problem. Cool. So just a couple of things here, and we'll dive into the portfolio and stop me at any point in time here and ask a question. But if you turn your attention to page 3, a couple of things I want to point out here. So this is when you look at this slide, and you really are breaking it down into these 4 quadrants, right? You have the upper left-hand quadrant when there's times of high inflation and low unemployment, the Fed's going to raise interest rates to combat inflation. At this point in time, when this slide was put together, the current range we're in that bottom left-hand quadrant, which was that no man's land unit rates. Now things have changed since then, and right now that red dot has shifted over to that lower right-hand quadrant, which in addition to the upper left-hand quadrant are the 2 times when areas when the Fed would be looking to actively change its policy. And so today, I don't know if you guys saw that the headline number for the unemployment came out, which is the historical largest it's ever been. It was over 3 million.
Right.
So you saw that red dot. It is shifting in its move to that lower right-hand quadrant. The Fed in preparation for all suit and try to combat this together. Any questions there?
No.
Okay, good. Just looking at the yield curve on slide 4 here, just to give you guys an idea of where things were at when we're looking at this December of 2018 to March of 2020. You still have that. You see that big inversion on the front end of the curve, which ultimately, this is a little bit, irrelevant at this point. It's obviously dropping down to 0. But to give everyone an idea, today you have the 5-year U.S. Treasury, which is the max that we can invest for a municipality in the state of Ohio, is at 51 basis points. The 2-year Treasury is at 31 basis points. And then you have the 12-month at 14 basis points. And even when you get into a 3-month U.S. Treasury, it's actually yielding negative right now. Hard to wrap your mind around, but there's negative yields in the short term right now in the marketplace.
Sort of uncharted territory, huh?
Uncharted territory. That's it. Yep, absolutely. So for us right now, when it comes to portfolio strategy, we're being very selective on the asset classes that we're purchasing and monitoring yield spreads to ensure that we're doing what's advantageous for our clients. Because at the end of the day, we still feel that there's a ton of, rightfully so, there's a lot of panic in the marketplace right now. So it's important to be not just to react and to digest what the information that's coming through and allow things to clear out. And I think with this next slide, getting on to page 5, when we're talking dating to the current past decade, there has been some type of market correction within the marketplace. So those red golden areas are recessionary periods or corrections with our economy. And you can see this past decade, look, there was no correction. We were on a long bull run in the marketplace. Again, employment was at low levels. Corporate America was chugging along. There was no correction. And then ultimately, it almost felt like we were almost due for some type of market correction, which ultimately we did receive, but I think it was, from our stand, if you look at it for a sustained period of time, we do know that. And so again, it's getting back into that slow growth trajectory again. Any questions?
No, sir.
All right. Again, the next page here, we're in the month. No country, these are developed countries or global central banks across the world. No central bank, even at this point in time, was looking to increase rates at all. The plans and projections were all to decrease or to keep saying, look at countries that were negative earlier in the month. They're lower now. So again, as a fixed income institutional investor, you're going to continue to look for higher credit and come into developed countries like the United States and purchase our fixed income securities, which obviously is pushing prices higher and rates lower, and that's what you're going to continue to see. Milestones, if you will, across each of these years. It seems like it was yesterday. The BP oil spill, and some of these, the Facebook IPO, and everything. It's been a fast decade, at least from looking at it from my end here, and obviously looking into 2020. The big things you're going to have are the presidential election, and you're going to have the coronavirus, and then to start this new decade. So it's always, you have to be willing to be able to adapt and change the strategy of your portfolio. So, we've had the Federal Reserve come out, and you've heard them say that they're not going to let the economy run into a downward spiral, if you will. They have putting new programs in place to ensure there's an ample amount of liquidity. I mean, it's just like we're in times when there's going to be like a war, if you will, here domestically. We're fighting this value chucking along. And that continues to look to be the case moving forward with the programs that they've currently put into place. And then in addition to the stimulus bill that you're looking through, looks like it will be passed. So you have monetary and fiscal policy work together to ensure we come out of this and it can move forward. Looking at the portfolio in general, the overall structure, if you will, this is as at the end of February, and as Timmy mentioned, you see some cash that was built up, so there was that overall maturity distribution. I don't know if you guys remember last time when we spoke, we were still focusing on going out longer and locking in these rates before yield, because we had the feeling, and based upon the inversion of the yield curve and other economic data that we were looking at, we were anticipating a little bit of a correction, right?
Right.
That strategy has paid off big time for us. Because right now we went out and we locked in, 46% of your portfolio is out in that 4 to 5 year space, which when we spoke in September the last time, we were only at 38%.
Mm-hmm. So
locking in those higher yielding coupons, again, if we're in this zero interest rate environment, 3 years from now, we go back to 2%, we're going to look pretty good. And it's going to pay off big for us from the interest income standpoint and strategy process. Right now, as things are coming due, we're just going to continue to assess where we're at cash balance wise at Peoples, and then also where the market is. And depending upon or at Peoples, and the areas right now that we're focusing on, let's say that we have a maturity in that 0 to 1 year space, and if we're maxed out of Peoples on deposits, the areas we're looking to focus on are that 1 to 3 year maturity window, where you can see we're a little light. Because ultimately, and this is my bias, if you will, and then ultimately looking at what's historically speaking, I feel that there will be some inflation that will start to we'll see as we get out of this slow inflation. So this will allow us to be able to adjust the portfolio accordingly and ensuring that we have an ample amount of liquidity on the front end of the portfolio.
Very good, Nick. Thank you for the explanation.
Absolutely. Hope that helped. I know it was a very, very high level 15-minute overview. I know you guys have some other things to chat about, but would that meet your expectations? And anything else maybe I said that maybe spurred any other questions or thoughts?
I just have a question, a curiosity of mine. I know in 2008, one of the issues, Nick, was the velocity of money. With the Fed pumping as much as it is now, what do we see in terms of velocity in the market?
Sure. And, that's a great point. I mean, you saw back in 2008 where the Fed really was that quantitative easing that I think you're maybe referring to, and where they were purchasing securities on the longer end of the curve to ensure that rates would stay lower and there was ample amount of liquidity in the marketplace. And you didn't see inflation. You saw just the prices of bonds change.
Right.
And right now, you're almost talking what we would call in the economics world as this helicopter money, which is a funny term of saying where you're seeing fiscal policy where individuals are given dollars to spend to stimulate the economy. So we're going to see the velocity of money uptick in our opinion. And I therefore think that you're going to see, especially where we were at, called the economy, and ultimately if individuals are saving that money that they're holding on to, that they're going to be receiving, and as things clear, we start to see more spending. You're going to see inflationary effects to that.
Yeah.
So I think that in my personal and our belief that you see it's going to be a little different than 2008 in that regard.
Well, thank you, Nick, and thank you, Tammy.
You're welcome.
Right.
Cool. Good guys. Well, I appreciate the time. We'll touch base here in a quarter. Hopefully this will all be behind us by then.
Entertain a motion to adjourn.
I'll so move.
Seconded.
All in favor to adjourn, signify by saying aye.
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 That was actually very good news, in light of the expectations,